I'm Elise Tan, and I'm your host for this episode of Hard Truth by Vertex. I'm really glad to have Ben Mathias on the show today. Ben Mathias is the managing partner at Vertex Ventures, Southeast Asia and India. I worked with Ben over the past year, and I find him to be a really humble person, despite his wealth of experience in venture capital and technology companies in Silicon Valley. So today, we are going to uncover his brilliance, his insights, and hard truths about startups, VC investment, and life. So hi, Ben.
Hi, Elise. Thank you for having me here on the show.
I'm really happy too. And how have you been these days?
Well, it's been a busy few weeks here in Singapore. We had a couple of conferences, so I am looking forward to the weekend.
So I'm really happy that you spent the time today to speak with us. So I know that you have a wealth of experience in venture capital, but before that, you actually switched from being in a corporate, right? So do you want to let us know a little bit, how does that happen? How did you change from being an executive at a technology companies into being in venture capital?
Quite by accident, actually. It so happened that one day I was having lunch with a college senior of mine, Kittu Koluri. And Kittu was somebody I had looked up to and was in touch with for several years. He had just sold his third company, I believe, and had switched from being an entrepreneur to becoming a venture capitalist. So he had just joined NEA. And over the course of the lunch, he asked me if I would be interested in talking to NEA. And my first response was that I had absolutely no background on venture capital. So Kittu said, it's okay if you don't have the background, as long as you are a cultural and personal fit for the firm, we will teach you the business. They were looking for somebody to start the India operations for the firm. And so I went in and I talked to the partners and everything worked out. And I joined NEA, initially working at the Silicon Valley office. And a year later, I moved to Bangalore and opened their India office.
That sounds so exciting. And I was reading about NEA, right? So they raised nearly 24 billion in total under AUM. That was in 2020. So it's a really huge company, doing lots of interesting investments. So, I think that's such a fantastic opportunity to join such an established VC firm, right, with the switch. Were you feeling, a bit worried at the time that you may not be able to maybe live up to the expectations? Tell us more about it.
Well, I had tremendous mentors at NEA. So Kittu Koluri for one, Mark Perry, who is now a retired venture capitalist, was a great mentor. Ravi Vishwanathan, who now runs Newview Capital, was another mentor. So I learned a lot at the firm, and I was there for almost 9 years. And then in 2015, I happened to have breakfast with Juhok from Vertex. Now I had just led the investment into First Cry at NEA, and coincidentally, Vertex had done the previous round. So Juhok was in Bangalore. He reached out and asked me if I could meet for breakfast. And that conversation turned out to be one about opportunities at Vertex. And Vertex was just getting ready to spin out the Southeast Asia and India fund into a separate independent fund. And I came to Singapore, met with Keylog, met with our chairman and deputy chairman, and things worked out, and I ended up joining as the third managing partner for Vertex Southeast Asia and India in 2015.
Wow, it must be really exciting times. And I want to also go back, to the time that you made the switch from being in corporates and then into venture capital. So firstly, how did your family respond, to the career switch and later on, very quickly, to a location switch?
Gosh, my family and friends all thought I was crazy.
Yes, you're changing your career at the age of 38.
That's correct. So in retrospect, it was a crazy thing to do. As you said, the age of 38, I was changing to a completely different career. And even more difficult, I was changing to a completely different geography. Now, India was the place I'd grown up in. I'd lived there as a child and as a student. I'd never worked a single day in India. Since the age of 22, India was just a vacation spot for me. So moving from to a different career and to a different country was kind of a difficult thing to do. But we did have a lot of close family and close friends in India, so we did have a support system. So when we moved back, it wasn't that difficult. And bear in mind, the country was going through tremendous optimism at the time. This was 2007. And it was 15 years after the major financial reforms that had been done by the government in 1992. And the country was seeing the benefit of those reforms. So there was tremendous economic growth. There was a lot of optimism in the country, and a lot of people were moving back from the United States and from other parts of the world. So it was a good time to go back to India and get set up.
Yeah, I think logically your change definitely makes sense. But I just want to ask you, what is the hard truth about transitioning from corporates to VC?
Well, transitioning from corporates to VC, it's a very different world. In a corporate, first of all, you have a team that works for you, and you have clear lines of delegation. You can delegate things to your team, and if things don't happen, you can assign it to somebody else. If somebody doesn't do their job, you can fire them. Here as a VC, you're an individual contributor. You basically are responsible for the work that you do and the decisions you make. And you have very little leverage over the outcome. Now, the only time you have leverage is when you make an investment decision. So you do the best you can to evaluate the founder, to evaluate the market, to evaluate the company, its differentiation. But once the money goes in, you are totally dependent on the founding team and what they do. Authority doesn't hold any longer. Now, in the corporate world, you have authority. You have authority over your team. You can basically give instructions, give orders, and things happen. In the VC world, it's influence that is important. Authority doesn't matter. You have to be able to influence your founders. And the only way to do that is to build that relationship with the founders, that they trust you, they look up to you, and they would value your opinion and your advice. So it's a very different world, being in the corporate world versus being in the venture capital world.
And I think that in terms of mindset and personality, that was something you have to shift as well, right? So tell us more about it and what is the hard truth?
Well, my personality did have to go through a change in 2006 when I had switched from the corporate world to a VC world. Now, in the corporate world, you interact with people in your comfort zone. So you interact with the people that you work with. Maybe you interact with your customers. Maybe you've got to deal with potential new clients. In the VC world, you're talking to new people every single day. You have founders coming to pitch to you. Sometimes in a given day, you may meet 3 different sets of founders. In a given week, you could meet 10 different sets of founders. And some of them may make sense, some of them may not make sense, but you have to be able to interact with them. And you have to be able to, first of all, you have to treat them with respect, because they are, at the end of the day, doing something that they believe in. So it is a skill set that has to be developed. The other thing about being a venture capitalist is that you are networking all the time. You have to network. You have to build relationships, because you never know when a relationship may be important. I'm looking at a company today. I need to do diligence on it. I suddenly recall, hey, 3 years ago, I met somebody that was doing something similar. Let me give her a call and get her feedback. Now, 3 years ago, when I met this person, I didn't know that I might need to use that contact in the future. So I did have to go through a personality shift. I had to become a lot more interactive. I had to become a lot more of a people person, because at the end of the day, the VC business is a people business.
Definitely. And I think as a firm, we truly believe that it's a people business. And also it's about nurturing leaders in whichever field, whichever areas that they choose to solve the problem in. Yeah, and I think that's what, really motivate me as well in coming to Vertex, working every day. I also want to share, one hard truth is that we definitely have to have good memory, because you mentioned about how you remember a meeting that was 3 years back and you never knew how you could actually culminate in a useful conversation afterwards, right? Yeah, so that's something that strikes me. What is something that you have to learn and unlearn?
Well, so the main thing you have to learn when you become a VC is something called critical thinking. Now, again, in an operator role, let's say you are responsible for sales or you're responsible for customer success, your role is very clearly defined. You know exactly what your metrics are. As a VC, you're looking at different companies every day. And you may look at something as diverse as, in the morning, you may look at a new direct-to-consumer brand. In the afternoon, you may look at something that is a new technology solution for climate change, and the next to you may look at the next greatest payment solution. All three very different businesses. Now, everything seems attractive initially. Founders obviously make a very good pitch. They make very compelling value propositions. The thing that you have to learn is critical thinking. So I always tell this to people who work with me at Vertex. Don't think about why you should invest in this company. Think about why you should not invest in this company, because that's when all the critical thinking comes out. Think of all the things that could go wrong and how would you mitigate that? And that's when you finally identify that 1 in 100 company that you are so compelled with that you really believe that you have to invest in.
And I think that this is the beauty of this business, because on one side, entrepreneurs, is really brimming with optimism. And for us, I'm not saying that we are on in terms of pessimism, but the thing is, we do give them another perspective. And I want to hear, the lessons that you learn in corporates. Yeah, how have you been able to apply over here?
Well, so some of the things I learned in the corporate world, of course, I left the corporate world 16 years ago in 2006. But interestingly enough, a lot of the tenets hold good even today. I mean, there are some fundamental things that regardless of whether you're in 2022 or 2012 or 2002, they hold true. So let me share 3 of them. So the first one, of course, most important for any company is the customer always comes first. The most important stakeholder in your business is the customer. I used to work for a software company that was doing very innovative things, was very successful. But somewhere along the way, they ignored the voice of the customer. Now, when the chips were down, the customers abandoned the company. So never lose sight that the customer always comes first. Number 2, your employees always need to feel challenged. Now, you can pay your employees a lot of money, but if they don't feel challenged, if they don't feel they're doing something interesting, they will leave. So that's the second thing. The third thing here is the executives need to stay engaged with the team. Now, of course, when you're a startup, everybody's in one room. The founders are in the same room as the developers, as the finance people. As the startup grows and as they get more money, there is a tendency to build a C-suite. And all the executives will be on one floor and everybody else will be on a different floor. Now, what happens in that situation is that the C-level execs lose touch with the people in their teams. The CFO needs to be with the finance team. The head of sales needs to be with the sales team. The head of operations needs to sit with the operations team. So never lose touch with the team.
Thank you for sharing the advice and also the hard truths. I must say that, for the past year, we have been interviewing as many as 20 of our portfolio founders. And I'm really thrilled to see that customer centricity is one of the most important things that they stress on. Yeah, and I think this is like what Ben Mathias mentioned is really important. Without the customers, there's no business, right? I also noticed that you joined NEA in 2007, and this is just before another global financial crisis. And right now, we're talking about a slowdown in VC funding and potential economic downturn. So we would like to hear more about, what was it like back then in the VC and startup environment? And did you see any similarities between what was happening now and then?
Well, I've actually lived through 3 crises. The first one was 2001, where I was working on the other side. I was in a technology company at that time. And then, of course, 2008 and now 2022. I see 2022 as being very similar to 2001. And the reason is because both are somewhat caused by the private markets and by the bubble in the startup environment. And in both situations, companies have been overfunded, companies that didn't need that much money. So you've had entrepreneurs that went out to raise $10, $15 million, but investors told them, take $100 million. Now, when you give a company $100 million and they only need 10, they will find ways to spend that 100, but they will spend it inefficiently. And at the end of the day, they will build businesses that are not sustainable. I use the example of Lake Mead in the United States. Now, Lake Mead has been drying up and the water level has been receding. And now that the water level has come down so low, you can actually see skeletons at the lake bed. And that's what's happening today. When the capital has dried up, you can actually see businesses that were built inefficiently without a proper foundation. Those businesses are being exposed. So the companies today that are actually doing well are the companies that could not raise a lot of money last year and the year before. And because they had less capital, they built more efficient businesses, more capital efficient businesses. They've figured out ways to get profitable. So today they are growing and they are profitable. We have companies in our portfolio where the founders couldn't imagine, why do people not want to fund me? Whereas everybody else is getting $50, $100 million. And we kept telling them, don't worry about it. Focus on your business fundamentals. Focus on your unit economics, which is what they did. Now, these companies today are, in some cases, almost $100 million in revenue and profitable and don't need any capital.
Which are these companies?
Sure, I can give you a couple of examples of companies that I personally am involved with. So one of them is a company called Kisht. Now, Kisht is a digital lending company in India, which gives short-term loans, 3 to 6 month loans. Unfortunately for them, this is little more than 2 years ago, they were all set to close around, and then that investor backed away for some reason. And after that, it was very difficult for them to raise any financing because their reputation was sort of clouded because everyone knew that they were going to raise money from this investor, and that didn't happen. So everyone thought there was something wrong with the company. Now, the founders said, they took this in their stride. They said, we don't have the capital, but let's work on our business so that we get profitable. And that's what they did. They built a business. They tweaked their business model so that they could still grow without the fundraise. They became profitable. Today, they're a significantly large revenue company. I don't want to mention the number because it's confidential, but they are profitable and growing very well. And now there are a lot of investors wanting to invest in them. Another example is Ace Turtle. Ace Turtle went through a similar situation. At the time of COVID, some of their business took a hit, but they turned that into their advantage. Once COVID hit, they actually changed their business model, and a lot of offline brands that were earlier dependent on them just for technology came to them and said, take over our entire business and manage the stores, manage the marketplaces. And that really transformed their business. So they used a bad situation and converted it into a good situation. And they also are growing and profitable.
Thank you for sharing these stories. I really love these stories because, like you say, they have managed to turn their business around. They managed to look at what are the other opportunities in the horizon and make it, something profitable. So I love to hear these stories about our portfolio companies. You have shared quite a bit about your career switch. You have also shared about your experience from the past financial crisis and also distill the insights and hard truths for entrepreneurs these days. So I would like to actually go into more of the venture investing side. Yeah. So for you, I think that you have such a unique position because you look at opportunities not just in India, but also Southeast Asia. Yeah, so I love that because when you look at industry across these different regions, we start to see a lot of different data points and we get even more comprehensive picture of how the markets are doing and how the founders can actually operate across these different markets. Yeah, so I also want to first ask you, what are you excited about in Southeast Asia and India for the next few years or even next decade?
Boy, I am very excited right now. And I do believe the next decade will be the golden age of venture capital in this region. Let me tell you why. So first of all, this region, Southeast Asia plus India together, is a $7 trillion economy. And it is important from the point of view that any startup that gets created in this region eventually expands geographically to cover the entire Southeast Asia and India. Some of the fastest growing economies in the world are in this region: India, Indonesia, Thailand, Philippines. So if you project this out in the next 10, 15 years, this could be a $15 trillion economy, Southeast Asia plus India, which is on par with the United States, with China, with the EU. So any startups getting created today will be building businesses for this $15 trillion economy. Now, if you look at some other macro facts, we have 1.3 billion internet users, active internet users in this region. Is the total number of US plus China put together. We have that number. The last few years, we've been adding 200 million internet users per year. So if you forecast the growth out in the next few years, we will reach 2 billion internet users, which is higher than all the rest of the countries put together. Now, these internet users are primarily millennials and Gen Zs. 56% of our population is either a millennial or a Gen Z. So these are digitally savvy users. These are people who do most of their shopping online. These are people who are very active on social media. And these are people who do their payments digitally. So the situation is very, very ripe for innovative startup companies to target these consumers, and also for SMEs to transform themselves by adopting digital technology. So I am very, very excited. This is a great time to be investing in this region.
Wow, 1.3 billion internet users. I think that sounds, really exciting, and I'm really happy to see what kind of startups they can be coming out to serve these consumers.